Tesla stock, is it heading to the moon or coming crashing back to Earth? That's what we're going to cover today. Now, three key pieces that we absolutely have to address when it comes to Tesla and Elon Musk. Obviously, with the purchase of Twitter or X, what does that mean for Elon Musk and his focus on Tesla? The Cybertruck, hey, it's finally out. Is that going to have a meaningful impact? And then lastly, is Tesla stock worthy of inclusion in your portfolio? So let's rock. All right, y'all. So here is my three-statement financial model for Tesla. I'm first going to go through the three financial statements themselves: balance sheet, income statement, and cash flow statement. I've highlighted a few areas specifically that I want to focus on over in orange, and I'm going to address those as we go along. Also, I have a stock chart on what's been going on with Tesla stock basically for the last 14 months. That's from the time that Elon Musk purchased Twitter, which is now X, all the way until today. So first things first, you look at the balance sheet, just a high level. Balance sheet always has to balance its assets, liabilities, and equity. And a few things that we want to focus on specifically with Tesla, if you look back in 2019, 2020, all right. The reason why that time frame is so incredibly important is if you look at the debt was actually decreasing and the cash was increasing, and the cash actually outpaced the debt for the first time in the company's entire history. So what that means is they went from being net debt, having more debt than cash, to actually being net cash. That gives you a tremendous amount of flexibility. Just think about in your own personal life. If you had more cash than debt, you have a lot more options. Another thing that I want to point out here, retained earnings. Retained earnings actually went from negative to positive. This is another tremendous result. This is something that all companies need to have. They need to have positive retained earnings. You need to basically hold on to more earnings than you pay out as dividends. So another great result there for Tesla. So Tesla went from this super high growth company that was questionable whether or not they were going to make it, I would say about 6 years ago.
We think they're 3 years ahead of any other auto manufacturer in two ways. One, very importantly, is the chip, and the other is their battery technology.
To now, it's no question. Tesla's here to stay, not going anywhere. From an operational perspective and a financial perspective, they are solid. Let's head down to the income statement. So a few things to focus on here with the income statement. The revenues, obviously ripping. You look from 2018 to 2022, basically quadrupled the revenues. We're talking billions of dollars here. So 21.5 billion to 81.5 billion. Absolutely incredible, unbelievable. Now, the other thing that I had mentioned earlier as it pertains to the debt and the cash, we see something else interesting happen here in 2022, where the interest income, the amount that they're making on their invested cash, has actually outpaced the interest that they pay on their debt. This is another tremendous positive result for the company. Moving on to the cash flow statement. Now, never forget, cash is king. A company has to have what's called positive free cash flow, operating minus investing cash flow. Now, if we look right here, you can see where that inflection point happens. It actually happens about 4 years ago in 2019. The operating cash flow actually outpaces the investing cash flow and just continues to moving forward. What this ultimately means is the company is generating enough cash from its operations to fund its future investment. Specifically, we're talking about capital expenditures, the company reinvesting in itself. So you want a company to be self-sustaining, self-funding in order to accomplish that. And that's exactly what happens here. The other thing I want to point out in 2022, zero for debt issuance. That's a huge positive as well, because that means that they didn't have to issue any debt. The fact that they're more reliant on their ultimate internal funding, super, super important. I have this stock chart over here, and I started the stock chart over in October of 2022. Now, the reason I chose that as the starting point is if you look on October 27th of 22, Elon Musk closed on the $43 billion buyout of Twitter. At that point, Tesla's stock was $225.09. Now, here's the significance of that. A lot of people had issues with Elon Musk buying Twitter. A lot of people are saying, hey, dude, how are you going to focus on Tesla if you now add another massive company, multi-billion-dollar company to your focus? Now, what I've heard in the past is that Elon Musk, in an 80-hour week, he spends 40 on Tesla and 40 on SpaceX. So where's the rest of the time going to go to focus on Twitter?
All right, so here I am playing Diablo. I have like a candle over there for atmosphere.
And the ironic thing is, if we look at the stock chart here, Tesla hit a 52-week low on January 3rd of 2023. It was $108.10. All right. That was a 52% drop since the closing of the Twitter deal. So obviously the market shared that concern. Well, guess what? It must have been overblown because it then ripped 171% increase over the next 7 months, hit a 52-week high of 293.34 on July 18th. So obviously not concerned, right? But guess what? Kind of wavered and went a little bit sideways for the remainder of the year. But guess what? Tremendous positive, right? Cybertruck. So the Cybertruck coming out, long anticipated. We see that it came out officially on November 30th. That's when the first deliveries took place. There was a big announcement event.
You know, you never know when the apocalypse could come along at any moment. And here at Tesla, we have the finest in apocalypse technology.
The Cybertruck was originally unveiled in November of 2019. That's literally 4 years ago. So now when it actually comes out, it's like, okay, we've been waiting 4 years for this, bro. And interestingly enough, I found a quote, October 18th, 2023. Musk was quoted as saying, "We dug our own grave with the Cybertruck." There was a 4-year delay from the original announcement. Think about it. Right now, we're talking about Christmas time. Imagine if you're like all jacked up about Christmas and it's like, yeah, Santa, 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 and then he doesn't come. And by the time he does come, it's 4 years later, like you've moved on. All right. So it's kind of the same thing here. So the real question is, what's going to happen with this stock on a going forward basis? Is it fairly valued? Is it undervalued? Is it overvalued? Well, the way that we make that determination is through building what's called a discounted cash flow model. We project the cash flows into the future, discount them back to today, and see what that value looks like relative to the current stock price. So let's get into that. So we have income statement items starting from revenues, going all the way down here to taxes. All right. We then have balance sheet items, required cash, down to debt. And then lastly, we have capital expenditures. So I'm going to go through my logic for each of these pieces right down here in the forecast drivers. What I've done with this financial model is I've created multiple scenarios. If you go up top here, all right, to cell H3, you can change the number and the number will correspond to the scenario. So scenario 1 is bear, scenario 2 is base, scenario 3 is bull. So if you change it to one of those 3 scenarios, it will actually go change all the numbers in the actual model itself. So if we look here, starting up at the top, we have the revenue growth. So this is something that was massive years ago, but obviously they 4x the revenues over the last several years from 2018 to 2022. So really, are they going to be able to maintain that level of growth? Absolutely not. It's what's called the law of large numbers. So it's much easier to go from $1 to $10 than it is to go from 10 million to 100 million. Simple as that. So it's no different with Tesla here. If we look 2022, they're at 81.5 billion for their revenues. The idea that they're going to, double that or anything is just a little too aggressive. What I actually did was I took the last 9 months of revenues, I divided it by 3 and multiplied it by 4. It's called annualizing the revenues. That actually got me a number of about 95.5 billion for 2023. So I'm pretty confident in this 97.75 number. That's based off of this base case. So continuing on from there, we see that cost of goods sold has been pretty steady. If you look in the lower right, whenever you highlight something in Microsoft Excel, you can actually see the numbers in the lower right. I'm focusing specifically on the average there. So you have an average over the last 5 years, 71.5. They have gotten a little better control over their costs. So it's come down to 70.2. So I'm fine with 70 for a base case scenario there. Depreciation and amortization. So again, last 5 years, we got 7%. The last 3 years, we have about 6%. So I'm just sticking with that 6%. Obviously, it's declined over the last 3 years. So you could go a little bit lower on that. But DNA is actually a benefit that gets added back to cash flow. R&D, very important for a company like Tesla. A lot of people say that Tesla is not a car company, it's a technology company. I somewhat agree. And what you see with technology companies is R&D. You see research and development. You're not going to see this at your average car company, right? Cars don't really change. But Tesla, I would say, is very unique in that regard. I also look at it as though it were a tech company, not a car company. So if we look right here, we see an average over the last 5 years of 5.1%, last 3 years, 4.4%. So I'm going a little bit on the higher side to be conservative here, because you see that it's been 4.8 and then 3.8 over the last couple of years. So 4.5 is a fair number to go with. Also, let me give you a heads up. When I say conservative, what I mean is lower on revenues and higher on expenses. That's always going to give us a more conservative result. Next, we see SG&A. SG&A stands for sales, general, and administrative. Think of this as overhead, what you're going to pay your workers, things like that. Things like insurance, that type of stuff. All right. So if we look, that's decreased over time. Again, that's really a function of the fact that they've increased revenue so much. So they have increased their actual SG&A, but as a percentage of revenues, it has come down. I would say because of the massive increase in revenues, these first 2 years are kind of throwaway, more like aberrations that throw things off here. The last 3 years, 7.5%, but last year, 5%. I would say this is a little bit more in line with reality on a going forward basis. So rather than go with 5%, again, going a little conservative, I go a little higher here at 6%. Interest rate on cash, this is important because they have so much cash. If we actually go look, 16.9 billion in cash. I mean, that's just completely freaking bananas to have that much cash. It's like more than a third world country's GDP. So when you look at something like that, that is actually going to be a significant inflow that they're going to have. In 2022, they have 1.7% as their interest rate on cash. I went with 2%, just pop the note up here. Ally Bank, they have a 4.75% savings rate. So 2% is super conservative. I would say a company like a Tesla could get probably much closer, if not more than 4.75. And frankly, treasuries are at like 5%, so they could just pop them in there. Interest rate on debt. So this one's actually fairly interesting. They've kept a very low interest rate despite rates increasing. They've still seen a decrease in rate. That's because they have something called an interest rate swap. What interest rate swaps do is they help you reduce the cost of your interest. So effectively what happens is if your interest costs are increasing, you can use a swap to decrease those rates. You can basically lock in a fixed rate. So what they've done is they've utilized these interest rate swaps. They've moved their interest rate on debt down. So if we look, 4.5% would actually be a fairly conservative number relative to where it's headed for them. Effective tax rate. So this is actually an interesting one. The current marginal federal tax rate for corporations is 21%. They have a lot of tax credits just for the simple fact that they have a lot of regulatory credits, being an environmentally sound and safe company. So they're able to utilize those credits to their advantage from a taxation perspective. Also, they've moved from California to Texas. That's had a major impact.
Same idea.
They've basically totally wiped out their corporate tax as a result of that. So that's also moving their taxes down. So 15% relative to the last couple of years is actually a fairly conservative number here. Required cash as a percentage of revenue. All right, so if we look at what they've had historically, started out at 20% in 2018, went as high as 63% in 2020, obviously COVID related, and then it's come back down to about 21% in 2022. Now, if I look at the note here, I have was 20 to 25% pre-pandemic. 20% is conservative, considering the growth profile has less need for cash. So again, kind of like most tech companies, they have a lot of cash that they're holding on to as a result, but how much cash do they actually require to run the business? Not 60%. And remember, there is an opportunity cost. When you hold on to more cash, that's less cash that you're actually deploying into the business. Accounts receivable, basically, if you sell something and someone doesn't pay you right then and there, they give you money later. So think of something like layaway, like an IOU, that's an accounts receivable. And they've been very consistent with this over time. You look at the last 5 years, 4.6% average. Last 3 years, a 4.4% average. So I split the difference, went with 4.5%. Inventory as a percentage of cost of goods sold. Cost of goods sold is the expensing of inventory. So if we look historically, last 5 years, we have 19.1%. Last 3 years, 18.7%. So going with 20% is actually above both of those numbers, fairly conservative. Prepaid expenses as a percentage of revenues. So prepaid expenses are effectively an asset. So if we look at the last 5 years, we see 2.8%, last 3 years, 3.1%. So I ended up going with 3%, fairly conservative. And then we have accounts payable, accrued liabilities as the percentage of cost of goods sold. We have a 5-year average of 40%, a 3-year average of 42%. I ended up going with 40%. It's a downward trend. So 40% is fairly conservative there. Now the debt pay down, if you look, they actually disclose the next 5 years of their debt payments that are scheduled. So I literally just take that right from there. And then CapEx as a percentage of revenues. If you look at the last 5 years, we have 9.2%. The last 3 years, 10.3%. I would say 10% is a fairly reasonable number. Now, what I want you to look at over here before we actually get into the valuation side of things, we have 3 scenarios, okay? So base case scenario is effectively like the most likely scenario. That's literally the scenario that we have running, and that's the scenario that I see over in the numbers there. Then we have a best case scenario. So this is basically increasing revenues, decreasing expenses. So we increase the revenue growth, and then if you look relatively speaking, left to right, we decrease all of these expense items. We decrease the tax rate. We even decrease the CapEx. And then if things are worse, what are we going to have? We're going to have lower revenues, and then we're going to have higher on the expense side. All right. So ultimately, if I want to change the scenario, I would just go up to here. I'll do it in real time. Hit the number 1, F9. It changes everything out. You'll see it down the bottom when we go through it, but ultimately you saw some of the numbers change there. That's what happened. But I always run it and keep it at the base case scenario to begin with. So moving back down here, let's go look at our assumptions for the DCF model or discounted cash flow model. We have the risk-free rate. So I got that from Yahoo Finance, FVX, 5-year risk-free rate. So it's a 5-year treasury rate because we have a 5-year model. Beta is effectively a measure of risk. If something or a stock is more risky than the market, it's going to have a beta of greater than 1. The market is a beta of 1. So I went through a bunch of different resources here: Yahoo, Zacks, Guru Focus, FinViz. So if I did an average, I'd probably get over 2. I think that's a little too aggressive for a company like this, for Tesla in particular. So I'm going with 1.5, which is still a very conservative beta. And then EMRP stands for equity market risk premium. That is the premium that you're going to require as an investor simply for investing in the United States of America. 4.25%. Grab that from my boy Aswath Damodaran, who is a professor over at NYU. And then we get the cost of equity, basically CAPM, or the capital asset pricing model, risk-free rate plus beta times the market risk premium. So now the pre-tax cost of debt, one of the issues that we have with Tesla, because they have all these swaps and everything, they actually have a cost of debt that is below the risk-free rate. Now that's impossible. Tesla is not less risky than the United States government. And all jokes and kidding aside, ultimately, if the US government goes to raise debt tomorrow and Tesla goes to raise debt tomorrow, I can guarantee Tesla is going to pay a higher rate on it. So we can't just use their actual cost of debt as a result. So what I did was I did what's called a spread analysis, where basically you look at the credit rating of the company, you look at a spread profile, and then you're going to add a spread on top of the risk-free rate. So the BBB rating, if you go on Damodaran's website, it actually has a little credit spread worksheet. So we end up adding 2% based on the risk of a BBB rating for Tesla. Cap IQ showed me that they had a BBB rating with a stable outlook as of October 2022. It hasn't updated, hasn't changed since. So we go with that. Effective tax rate, so that's the 21% marginal tax rate. We get a post-tax cost of debt, or pre-tax times 1 minus the tax rate, 4.94%. They're basically, very little debt in terms of the capital structure, mostly equity. So we have the WACC calculation, cost of equity times weight of equity, post-tax cost of debt, weight of debt, boom, we get 10.6%. And this is a very conservative number. This is what we're going to discount the cash flows by. So a dollar today is worth more than a dollar in the future. So what we're going to do is take those future dollars, discount them back to today. We have the current share price, 243.84. The shares out has come from the cover page of the 10Q. That gives us a market cap right here, $775 billion. Book value of debt. So they have $4.4 billion of debt as of their September 30th filing. Something to note here, which is really interesting and unique for a company like Tesla. They have $3.7 billion of ABS, which stands for asset-backed securities, against car leases. So this is actually pretty cool. So what they're doing is they're taking the car leases that they have and the cash flows associated with that, and they're actually raising debt against those cash flows. So basically the debt is going to have those cash flows backing it up as that asset. So think about it like if you were going to get a home loan, right? A mortgage, they would look at the cash flows produced if it were an investment property. So it's the same concept. This is pretty cool and pretty unique for a company like this. Non-controlling interest, basically interest that other companies have in Tesla. So we have to strip those out. They don't have any associate investments, so they don't have any investments in other companies. Almost 16 billion of cash. And then we have these last two components here. This is related to what's called the terminal value. So we have a 5-year financial model here, but the company doesn't stop functioning after year 5, right? It keeps going after that. So ultimately what we have to do is we have to calculate what's called a terminal value. So we look at the very end of the model, we see what the company's doing then, and we have two options. We could take the terminal cash flow, multiply it by 1 plus the terminal growth rate divided by WACC minus the terminal growth rate, or we can have an EBITDA multiple where we basically take a multiple and multiply it by EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So now the current TEV to EBITDA for Tesla is about 46 times. So I went with 40 times. So less would give us a more conservative number. Let's get into the actual DCF. Woo, woo. All right, y'all. So we start out with EBITDA. We strip out DNA. That gives us EBIT. Then what we're going to do is strip out the taxes. So effectively, we would have EBI, earnings before interest. Now, this is very important because what we're trying to calculate is unlevered free cash flow. Unlevered free cash flow means that the debt holders haven't been paid yet. So what are we going to do? What we're going to do is we're going to pay the debt holders later. What we're going to get from this analysis is what's called a TEV, or total enterprise value. That total enterprise value, we're then going to pay the debt holders. That's going to give us our equity value. So we add back, all of these are cash flows. So we add back DNA. We have changes in accounts receivable, inventory, prepaid expenses, accounts payable, and accrued liabilities. All of this is coming from the cash flow statement projections up above. We then reduce it by the capital expenditures, which is the investments that they need to make for the long-term growth of the company. And this gives us FCFF, free cash flow to the firm, basically cash flow that's available to both debt holders and equity holders. We then have our calculation of the terminal value. So this is 40 times the EBITDA. I had mentioned that multiple a little bit earlier. We add all of these across, and then we have the discount factor. So obviously a cash flow in the future is worth less in today's dollars. And specifically for Tesla, 5 years from now, those cash flows they generate are only worth 60 cents on the dollar today. So we multiply all of that out. We add that together. That gives us our total enterprise value. That's the value of the entire firm to both debt holders and equity holders. We pay the debt holders, so we strip out the debt. We add back the cash, that almost $16 billion worth of cash. They have a little over $1 billion in non-controlling interest, so we switch or strip those out. And then we have no associate investments. So this gives us an intrinsic equity value of a little more than $1 trillion with a T. Crazy, right? So now what we have to do is we take the shares outstanding, and then we're going to divide that equity value divided by those shares. It gives us an implied share price of $318.24. Now the current share price as of the time of this model, $243.84. So our value is higher than what we calculate, or the value that we calculate is higher than the most recent share price. That gives us a discount 23.4%. So basically what we're saying here, folks, is the current share price, if we buy Tesla today, we're paying $243.84 for something that's worth $318.24. So therefore, that would be a rating of a buy. The way that we come up with the rating, if you actually look in the formula bar up top, it says if the number is less than minus 20%, it's a buy. Basically, if we have more than a 20% discount, it's a screaming buy. If it's between 0 and 20%, that would be a hold, meaning if we already own it, we would keep it in the portfolio. If we didn't own it, we wouldn't buy it. And then lastly, if it's at a premium, obviously, if we say this thing's worth $318 and it's actually trading at $350, we're not going to buy the thing. We don't like losing money. So that covers the valuation. So we went through the 3 financial statements, the projections, how we came up with the forecast. This piece, though, is not where we end. What we also need to do is we need to say, okay, that's all good and well, but what if we ran different scenarios? What if we changed the numbers? What would happen in those instances? That's what's called a sensitivity analysis. What we're going to do is we're going to take the company, we're taking the financial model that we've built, and we're going to say, you know what? Instead of 20% revenue growth, what if we ran it at 15? What if we ran it at 25? And then that gives us a new range. And what I did was I color coded based on those same rules that I just gave you a few minutes ago. 0 to 20% would be a hold. If it's obviously above the current share price, then it would be a premium. And then if it's less than 20%, more of a discount, then it would be green and a screaming buy. And what you look at is the center scenario in each instance is what we're currently running, the base case. So effectively, the base and the bull are screaming buys in both instances. So we did one with the terminal multiple and the weighted average cost of capital. We did another one with revenue growth and CapEx intensity. And I have the discounts off to the right here. So you could see pretty much buy for the vast majority of the instances here. But I have one other thing that's really important when you build out a financial model, and that's what's called a scenario analysis. So a scenario analysis is pretty cool because what we can do is we can run each of the scenarios and see what the value would be. So if you change this right here, you change it to the bear case scenario, it gives you an intrinsic value of 221.72. If you change it to the base, which we're currently at 318.24, if you change it to number 3 or the bull, you get 443.47. So what I did was I said, you know what? I think there's the same probability of an upside versus a downside. Now, if you have a certain opinion, like you're really strong against them having this major upside, you might change it to 50% bear case, 50% downside, and then 25 base, 25 bull. It's completely up to you. It's your choice to make that decision. I don't think there's any obvious directionality one way or the other. So what I did was I said, okay, if there's a 1/3 chance, there's the same likelihood of an upside, steady state, or downside scenario, what is that going to result in? So if we look at the bear case scenario, we actually get a sell rating. It would be trading at a premium at the current price. At the base, we already saw this. We have a buy rating. And the bull, we have like a screaming buy rating. So what I did was I effectively said, okay, what is that going to give me in terms of a result? If I do a little weighted average here, I get 327.78. That is a 25.6% discount, which is definitely a screaming buy. It's a sell in the bear scenario, a buy in the base and bull scenario. So you can change these probabilities around however you see fit. And this is ultimately the financial model. Tesla, I would say, based on the analysis that was done here, does seem very appealing for sure, and something that you should consider in your portfolio. Now, just to let you know, I am not a financial advisor, so you need to take that into account. So this is just my opinion. This is not investing advice. I don't know who you are. I don't know where you're from. So I don't know your situation. So I'm not telling you to do something or not do something. That being said, if you are interested in this model, I have a link down below. If you click that link, I will be more than happy to send you this financial model. And also, if you enjoyed this video, please don't forget to smash the like button and subscribe. I really appreciate all of you, and I hope to see you in the next video. Take care, everybody.